Stocks hit new all-time highs, and we are now just a little over 2 weeks away from the U.S. presidential election. I'm Graham Summers, and this is Bulls, Bears, and BS. Welcome back to Bulls, Bears, and BS. I'm Graham Summers, Chief Market Strategist for Phoenix Capital Research, and today is Friday, October 18th, 2024. So the biggest thing we need to acknowledge is kind of the big picture from a macro perspective, specifically pertaining to what central banks are doing. We live in an environment in which central banks have a truly profound effect on how the financial system operates. They're intervening in ways that were never anticipated by the legislation that introduced these entities, and so we're in a very sort of top-down, central-driven macro landscape. I bring all of this up because a massive seismic shift has happened in the last 3 months. 3 months ago, we were in the middle of the summer. At that time, the only central bank that was easing was the European Central Bank. They had just cut rates for the first time in May. You fast forward to today, you've got the European Central Bank has now cut rates 3 times. The Federal Reserve, which is the U.S. central bank, has now cut rates by 0.5%, which is a very aggressive rate cut to kick off an easing cycle. And you've also got China involved in a large-scale stimulus intervention measure. So what does this tell us? Well, what this tells us is that the entire global financial system is currently in an easing cycle. And that's going to have very profound effects on us, on asset classes. From 2020 to 2022, we had an easing cycle. Risk assets, specifically stocks, shot through the roof. Inflation appeared. In 2022 to late 2023, we had a tightening cycle, which consisted of central banks draining liquidity and raising interest rates. That was negative for risk assets and positive, also negative for bonds. Fast forward to today, and now we're in a coordinated easing cycle. And this is very significant because you have to remember that in today's financial system, everything's interconnected. The largest financial institutions are all multinational in nature. They all trade and engage in swaps with counterparties in other countries. And so if one central bank implements a major easing cycle, it doesn't just stay, the money doesn't just stay in that country. You know, if the Federal Reserve decides to start easing rates and easing monetary policy, the money the Fed prints, the cheapness of the money, it doesn't just stay in the United States, it flows everywhere. So the fact that you have this coordinated easing cycle where every major central bank, specifically the 3 largest economies, Europe, China, and the United States, and I'm counting Europe as one whole economy here, those 3 largest economies now all have central banks that are easing. So that has a very profound effect on risk assets. It's going to be highly beneficial. It's likely that the stock market's going to continue to do well, but it also might be problematic as far as inflation is concerned. Now, we have started seeing a slight uptick in inflation policy, inflation forward expectations. It's not gotten to the point yet where I'd be really concerned, but the basic gist of it is, if you think of the financial system as kind of like the ocean, you know, the tide's now going to be rising because all of these central banks are easing, and a rising tide's going to raise all ships. That's not to say there won't be volatility. That's not to say that we couldn't have a bear market appear in the next year or two. It's just simply that right now, today, the market is in an easing cycle, and that's going to be largely positive for risk assets. The other big development concerns the U.S. presidential election, which will be happening on November 5th, which is a little over 2 weeks from today. I'm not going to really get into the politics here because I don't really see the point of it, and it's honestly, politics is generally speaking an ugly business, but it's fairly obvious at this point that the markets are discounting a Trump win. The betting markets have Trump winning, the odds at 60%. Unfortunately for Kamala Harris, every time that she appears in public and gives these large-scale interviews, it really hurts her numbers. It looks as though we're going to see Trump win in a pretty significant way. The question now is whether or not Republicans take Congress. I don't really have any insights on that. All I can say is that what Trump's inheriting is going to be a very interesting situation if he wins, because the U.S. is adding about $1 trillion in debt every 100 days, and that's truly unsustainable. So the question is, the way I would think about this is, for the last, say, 4 years, the United States has had this massive fiscal kind of push in the sense that they've been spending so much money and it's been running such a large deficit. It's been running the largest deficit in history outside of World War II. And if you actually look at the deficit as a percentage of GDP, the deficit we've been running is equal to like what we ran during the Great Financial Crisis. And remember, the economy has been growing this whole time. So you've got an economy that's growing, but we're running a deficit that typically you would run for a massive, massive recession. And that's a big reason why the economy has really refused to roll over in any significant way. When you're spending that much money, it's going to be very hard for the economy just to sort of roll over and enter a recession. But all of that kind of changes dramatically when Trump takes office, because the reality is, sure, he can probably engage in some stimulus and interventions to try and keep things going the first maybe year. But you cannot continue to run these deficits. It's simply not feasible, which means we're going to see the fiscal situation change sometime in the near future. And that's going to have a very profound effect on the economy. It's going to have a profound effect on risk assets. But the way I would think about it right now is monetary policy typically is about 12 to 18 months ahead of curve. So what the Fed just started doing, we're really not going to feel the effects of that until the end of 2025. And so the Fed's really behind the curve in terms of trying to get ahead of things to cushion some of the cracks we're seeing in the labor market. And this is happening at the same time that the fiscal situation is likely going to be changing, so we're going to see that start getting discounted as well. And it's going to really change how things are playing out. But for now, we're very clearly in a very aggressive, strong risk-on environment. The economy continues to chug along, driven by all this fiscal sort of spending. Indeed, the Atlanta Fed's GDP Now estimate has come in with the economy growing at an annualized rate of 3%. This is definitely not weak. We also see the Red Book Index, which measures year-over-year same-store sales for retailers, is up 5.6%. This is, again, not weak at all, indicates the consumer is strong. I know a lot of that seems sort of counterintuitive. How can the consumer be so strong when inflation is, still a problem for people? And the reality is that when we talk about the economy, you're talking about everything in the aggregate, and for those people who are in the top 10%, 5%, 1% of this economy, things are looking quite positive. Housing prices are through the roof, stock prices are much higher, incomes are rising. And so that whole group of people is kind of spending in a way that's sort of covering up what's affecting everyone in the lower 80% of this country. And I'm not saying this to be kind of heartless. I'm just saying when you measure the economy, you're measuring everything. You're not really being, ethical or spiritual in how you look at things. I mean, think of it this way. Let's say the economy was 5 people in a room, and 4 of those people have incomes of, say, $40,000, and then one of them is worth $10 million. The $10 million person is going to be spending so much money that as the aggregate, the room's going to look as though it's doing quite well, economically speaking. But it's really being overshadowed by the fact that one individual has so much money and is using it in such an aggressive way that it's sort of covering up the difficulty the other 4 people are having. That's sort of the economy we're in right now. I was writing about this over a year ago. It's sort of a 2-tiered economy right now. If there's someone that owns assets, meaning like real estate, stocks, things like that, things have been looking really quite good because the Fed's easing, the inflationary push, all of this stuff, the economy growing due to the deficit, all of that has really boosted asset prices, which creates the wealth effect, which is that someone feels quite wealthier because their net worth's gone up, so they're more inclined to spend money. For those people who are in the lower 80%, the inflationary picture has been very challenging. It's been very difficult for these people. And these are typically individuals that don't own assets, and consequently, they don't have the wealth effect. They don't have the things that benefit from Fed policy. And so it's really a 2-tiered economy right now. And in the aggregate, the top 10%, specifically the 5, 1, and 0.1%, are kind of, eclipsing what's going on for everyone else, making it look like things are going well. So I don't want to sound like I'm insensitive when I say the economy is doing well and stocks are doing well. I'm fully aware of the picture as a human being, but this is just how these things are measured, and it's how we think about these things in terms of investing. That's really all I have for you this week. There's not much point in getting too in the weeds on things, specifically with, the election coming up, and we still have room for an October surprise. So For now, I'm simply going to say the Fed and other major central banks are in an easing cycle. The reflation trade is active. This is benefiting Bitcoin, gold, cryptocurrencies, that kind of thing. And it's overall positive for risk assets, specifically stocks. But all of this will be changing, most likely this time next year. The fiscal situation has to change. The Fed can continue to ease, but it depends on how inflation appears. And really, it's just a big question of what happens at the election. It's pretty obvious at this point, but again, you never know, and there's always room for surprises. On a final note, wanted to alert everybody that if you haven't had a chance to look into our crypto trading product, Crypto Pro, you really should do it. Our first pick, which was made just last Monday, is already up over 20%. We're really excited about this product. We think it's going to show investors some tremendous gains, specifically as we enter into this inflationary, reflationary macro framework. So if you have any questions about that, email us at support@phoenixcapitalresearch.com, and we're happy to help you out. I'm Graham Summers, and this is Bulls, Bears, and BS.